Hello everyone, my name is Karan Sehgal and we'll continue with the training session of IFRS 15 Revenue from Contract with Customer. In today's session, we will cover the multiple topics covered under the five-step model of IFRS 15 Revenue Contracts with Customers. The topics are cost to obtain and fulfill the contract, contract modification, sale with the right of return, warranties, principal versus agent, customer option for additional goods or services, licenses, and sale and usage-based royalties. Cost to obtain a contract. There are certain incremental costs incurred by the entity for a contract, like sales commission. As per the new standard, these costs are required to be capitalized only if these are incremental in nature. There is also a practical expedient which allows entity to expense of such cost if the duration of the contract is less than 1 year. If there are certain costs incurred, irrespective whether the entity enters into a contract with a customer or not, then such costs do not qualify as incremental cost and needs to be expensed as incurred. This guidance is not optional, which means that all the entities need to put a process in place to capture all the costs incurred related to the contract and assess if there are any costs which are incremental in nature. This can result in significant effort for many entities who are currently not tracking these costs. Let's look at an example of cost to obtain a contract. A and B are in the process to enter into a contract. The contract is still under discussion. A has a team of 5 members from its current workforce who would work on this contract for the next 3 months in the negotiation process. The salary cost of the employees are $20,000 and they will be involved in this project for the next 3 months. A is also expected to incur a cost of $10,000 on travel and lodging expense. A has also hired a team of lawyers. The lawyers would be paid $10,000 as legal fees. In case the contract is signed with B, A would pay a commission of $15,000 to the lawyers. Which of the costs incurred by A would be capitalized? Now, the cost related to employees, salary, travel, and lodging, the lawyer fees, would be incurred irrespective the contract is signed or not. As these costs are not incremental in nature, they would be expensed as incurred in the P&L. In case of sales commission to be paid to the lawyers, these costs would only be paid if the contract is signed successfully. As these costs are incremental costs, it will be eligible to be capitalized over the life of the contract term. Cost to fulfill the contract. There are costs incurred by the entity which are eligible to be capitalized as fulfillment cost if certain criteria are met. First criteria, if it is not in scope of other guidance like inventory, plant property and equipment, intangibles, and other standards. These costs are related to the existing contract or anticipated contracts. The costs are expected to be recovered. These costs generate or enhance resources which would be used to satisfy the performance obligation in the contract. If all these four criteria are fulfilled, then the cost will qualify as a fulfillment cost and will be capitalized in the balance sheet. Look at a case study on fulfillment cost. A enters into a contract with B to create a software for B. In order to create a software, A needs to perform design services. These services would help A to create the software which would meet the business requirement for B. Now let's assess whether the design services qualify as a fulfillment cost. As discussed in the previous slide, there are certain criteria which needs to be fulfilled in order for an expense to qualify as a fulfillment cost and capitalize in the balance sheet. The first criteria, these costs should be outside the scope of other standard. Now, when we look at the design services, it is not covered under any of the other standards like inventory, plant property equipment, and etc. Design services are provided for the contract in scope. The design services cost would help entity in satisfying the performance obligation, and as it is a profitable contract, A expects to recover the all the cost incurred for design services. As all the four criteria are met, the design service cost qualifies as a fulfillment cost and can be capitalized in the balance sheet and needs to be amortized over the life of the contract. Now, we have already discussed about the cost of incremental cost and fulfillment cost when it can be capitalized in the balance sheet. Now, let's discuss on how these balances needs to be amortized and impairment of these balances. The entity needs to amortize the incremental and fulfillment cost over the life of the contract in a way that depicts the transfer of good or service to the customer. The duration of the contract would include the existing contract as well as the anticipated contract in case of a renewal. The entity needs to recognize impairment if the recoverable cost is less than the carrying amount of the asset. Contract modification. A contract modification occurs when there is a change in the price or scope, or both price and scope, approved by the parties to the contract and enforceable by law. The accounting for the modification would depend on whether the additional goods or services added to the contract are distinct in nature and the changes in the price of the contract. It is important to note that these changes needs to be approved by the parties involved in the contract. In case the modification of the contract is still under discussion, then the accounting would continue as per the original contract. This guidance is applicable to all revenue contracts with the customer. The new standard requires an entity to account for modification either on prospective basis or cumulative catch-up basis depending on the different scenarios covered under modification. Now let's look at different scenarios under contract modification. Scenario 1. As per the modification of the contract, the additional good or services are distinct in nature and the price agreed for this additional goods or services commensurate with the standalone selling price. Such scenarios would be accounted as a separate contract for such additional goods or services with prospective impact on revenue. Scenario 2, where the existing contract is terminated and a new contract is created. As per the modification, if the additional goods or services are distinct in nature, however, the price offered for these additional goods or services does not commensurate with the standalone selling price, then it would result in cancellation of the existing contract and creation of a new contract. The remaining performance obligations to be recognized as revenue as per the original contract and the additional consideration under the contract modification would be recognized over the contract term, which faithfully depicts the transfer of goods or services. Scenario 3, which results in a cumulative catch-up adjustment. In case there are additional goods or services added to the contract, however, these additional goods or services are not distinct in nature, then it would result in a one-time cumulative catch-up adjustment depending on the changes in contract. This can result in either a reduction or an increase in the revenue recognized due to the modification in the contract. Let's look at a case study to understand the concept of contract modification. A enters into a contract with B to provide 400 mobile phones. The price of each phone is $50. After 3 months, there are few changes made to the contract. A and B agree to add 50 more mobile phones at a price of $40 each. In the first 3 months, A had transferred 40 phones to B. As there has been a change in the price and scope of the contract, and let's assume that both the parties have agreed for the change in the scope and price and it's enforceable in nature, then it's a valid contract under the modification. There are additional goods or services added to the contract which are distinct in nature. However, as the price of this additional goods or services does not commensurate with the standalone selling price, it would result in prospective change in revenue recognition. The original contract would be terminated and there would be a new contract for 60 phones to be transferred under original contract and 50 phones to be transferred under the modification. That is a total of 110 phones. The transaction price would be 60 into $50 and 50 into $40, that is $5,000. This transaction price would be for a total of 110 phones, so the transaction price for each phone is $45, which would be recognized as and when the control is transferred to the customer. Enters into a contract with B to build a software. The transaction price agreed for this software is $500,000. The expected cost to be incurred is $400,000. In the first 3 months, A has incurred a cost of $120,000. That is, A has completed 30% of the software and has recognized a revenue of $500,000 into 30%, that is $150,000. After the first 3 months, A and B have agreed to make changes in the software which will result in a lot of rework for A. There has been a change in the price of the contract and the transaction price has been increased by $100,000 and the estimated cost increase is also $100,000. After the approved contract modification, the transaction price would be $600,000 and the estimated cost would become $500,000. As the cost incurred to date is $120,000, the entity needs to recognize revenue, that is, the cost incurred $120,000 divided by the total cost estimated to be incurred, that is $500,000, which is 24%, and the total transaction price, which is $600,000, needs to be multiplied by this 24%, and the revenue should be $144,000. As the entity has already booked a revenue of $150,000, this means they need to reverse $6,000 because of the cumulative catch-up adjustment under contract modification. Now let's look at the next topic, which is sale with the right of return. There are contracts where the customer has a provision to return the goods back to the entity. These are sales made with a right of return. In such cases of right of return, the entity needs to estimate revenue under the guidance of revenue recognition and recognize revenue on transfer of control to the customer. When the entity makes a sale with the right of return, it would recognize revenue for the amount it expects to collect from the customer. There would be a refund liability recorded as well, which would be the difference between the consideration collected and revenue recognized as per the new standard. There would also be an asset recorded capturing the cost of inventory expected to be returned. The entity needs to update the estimation of refund liability at each reporting period. Now let's look at a case study which will help us to understand this concept in a better way. A sells 100 mobile phones to B. The price of each phone is $20. As per the terms of the contract, A has a right of return the phone to B in the first 30 days. The cost of each phone for A is $16. Now, as there is a sale with a right of return, A need to estimate how much return it expects, which would depend on the historical trends. The average return rate is 5%. Now, when A estimates the transaction price, it would estimate the transaction price as if it will transfer 95% of the goods to the customer. So the transaction price would be number of phones, which is 100 phones into $20 into 95%, that is $1,900. Now, when these goods are transferred to the customer, A would collect the consideration of $2,000. Now, the difference between $2,000 and $1,900, that is $100, would be recorded as a refund liability. A also needs to record an asset for inventory expected to be returned, which is 100 phones into 5% into the cost of each phone, which is $16, that is $80. Now, at the end of 30 days, let's assume that none of the phones have been returned. In this case, all the refund liability would be transferred to revenue and the asset for inventory would be released to cost of goods sold. Let's cover the next concept, which is warranties. Under the new standard, warranty is accounted as a separate performance obligation if it is distinct in nature. There are several scenarios which might result in warranty being a separate performance obligation. If the customer has an option to purchase the good or a service with or without the warranty, then warranty would be distinct in nature. Similarly, if the warranty offers something on top of the standard warranty, then it might result in a distinct performance obligation. For example, if the standard warranty for a product is 1 year, but the entity is offering a warranty of 2 years, then the warranty would be a distinct performance obligations. If the warranty is assessed to be a separate performance obligation, then the entity needs to apportion the transaction price to warranty as well. There are two kinds of warranties: service type warranty and assurance warranty. When the entity provides to a customer a warranty which provides an assurance of compliance with the agreed upon specification, then it is an assurance type warranty and would not be a separate performance obligation. However, if the entity is providing something which is beyond the agreed upon specification, then it is a service type warranty and entity needs to account as a separate performance obligation. Let's look at a case study which will help us to understand this concept in a better way. A sells a laptop to B with a warranty of 12 months. When A normally sells a laptop, it provides a warranty of 12 months. However, A promises to pick up the laptop from B premise and send an engineer within 12 hours to do the same. This is something which is normally not a part of a standard warranty package. As A is offering something above the standard specification, that is a pickup service, the pickup service would be accounted as a post-contract service and to be accounted as a separate performance obligation. As it is a separate performance obligation, it needs to ensure that it allocates some transaction price to this separate performance obligation and recognize revenue as and when it is satisfied. Principal versus agent. When a third party is involved in providing goods or services, then the entity needs to assess whether the nature of its promise is a performance obligation to provide specified good or service itself or arrange for a third party to provide those goods or services. This is done by identifying each good or service in the contract and evaluate whether the entity obtained control of these goods or services before it is transferred to the customer. An entity which acts as a principal may satisfy the performance obligation by itself, or it might engage a third party to satisfy the performance obligation on its behalf. When the entity is a principal, it records revenue at gross basis. In case the entity is acting as an agent, then the revenue is recognized at net basis. As mentioned earlier, if the entity has not obtained control before transferring the good or service to the customer, then it is acting as an agent in the transaction. The following indicators are used to assess whether the entity qualifies as in principal or not. Does the entity have inventory risk? Does the entity has a discretion to establish the prices for the specified goods or services? Who has the primary responsibility for fulfilling the contract, the entity or a third party? If the entity does not bear any inventory risk or doesn't have a say in determining the price of the product, good, or service, or is not responsible for fulfilling the obligation mentioned in the contract, then it is more likely that it is acting as an agent and is to recognize revenue at net basis. Let's look at this next concept, which is customer option for additional goods or services. When an entity provides an option to the customer to acquire additional goods or services, then the entity needs to assess whether there is any material right that the customer would have not received without entering into the contract. The entity also needs to assess whether the right to acquire additional goods or service is at a standalone selling price or at a discounted price. If it is at a standalone selling price, then there is no option with the material right. However, if it is provided below the standalone selling price, then the material right becomes a performance obligation, and the entity needs to value the material right, defer the amount from the transaction price till the time the option period lapses. Once the option period lapses, then entity would transfer the deferred amount and the material right into the revenue account. Let's look at an example to understand this concept in a better way. A enters into a contract with B to provide for printers. As per the terms of the contract, A gets a special discount for 20% once it buys 100 laptops for all its additional purchases. So once B buys anything over 100 laptops, it gets an additional discount of 20% only on those additional purchases. Normally, such discounts are not offered by A to all the customers. Since there is an option provided by A to B to purchase additional goods, let's look at the next concept, which is accounting for licenses. A license establishes a customer's right to the intellectual property of an entity. Some of the examples of licenses are software and technology, franchisees, patent, trademarks, and copyright. There can be a scenario where the entity is transferring other goods or services along with the licenses. These promises can be specified in the contract explicitly, or it can be a valid customer expectation, that is, an implied promise. The entity needs to assess the total number of performance obligation in the contract. If the customer can benefit from the license on its own or together with other resources that are readily available, and the license is separately identifiable from other goods or services in the contract, then the license is treated as a separate performance obligation. In case the license is not distinct in nature, then all the promised goods or services are treated as a single performance obligation. Once the entity has determined whether the license is distinct in nature or not, the next step is to determine the nature of the distinct license. In this step, the entity needs to determine whether the revenue recognition happens at a point in time or over the time. Now, if the nature of the license is right to access, then the revenue is recognized over the time, and if it is right to use, then the revenue is recognized at a point in time. To determine whether the license is right to access or right to use, there are certain criteria which needs to be assessed. These criteria are as follows. The contract requires or the customer reasonably expects that the entity will undertake activities that significantly affects the intellectual property to which the customer has the right. The right granted by the license directly exposes the customer to any positive or negative effects of the entity's activities identified. Those activities do not result in any transfer of goods or services. An entity affects the IP when the activities are expected to change the form or functionality of the IP, or the ability to obtain the benefit from the IP is substantially derived from or is dependent on those activities. If all the above criteria is fulfilled, then it is a right to access, that is, revenue is recognized over the time. If not, then it is right to use, and revenue is recognized at a point in time. Sale or usage-based royalties. For sale and usage-based royalties that are attributable to a license of IP, the amount is recognized at a later of when the subsequent sales occur or and the satisfaction or partial satisfaction of the performance obligation to which some or all of the transaction price is allocated. This is an exception to the general requirement. It applies when the royalty relates only to the license or the license is the predominant item to which the royalty relates to. Well, this brings us to the end of the session where we have covered the multiple topics under the new revenue standard. Stay tuned for the next session, which is presentation and disclosure. Thank you.